And the judge said, no, you just told me you make $400,000 a year. When people say make, they mean that's what they earn, not what they gross.
We're back, everyone. Another episode of the Financial Dad podcast. How are you doing today, Dad?
Doing great. How are you?
You were just telling me about a very interesting YouTube video that you came across as I was talking about, what do you do with your money when you start making bank, quote unquote? What does that even mean? So I want
Right,
you to
right.
start with your court case YouTube story, because I think this will illuminate and illustrate the concept that we're going into today.
Okay, okay. Well, just the context of the conversation so that it's clear where this is going was that we have to be sure people understand the terms, things like gross revenue, expenses of a business, profit of the business, which would be very similar to salary, like what you're actually quote unquote earning from the business. Okay. So there was this YouTube thing, and I think it was actually like a Judge Judy type of thing where it's a kind of a fake court case, but it was a divorce case, former husband and wife, where the husband was petitioning the court to stop paying child support because he had taken over taking care of the kids, number one. And number two, though it appeared as though the wife was doing a lot better financially than even the husband. So, it was unfair at that point. So the wife, by the way, comes into court dressed to the nines, glammed up, almost ridiculously so. And during the course of the thing, and by the way, she's got an attitude. It's actually she gets a comeuppance, and it's quite fun.
It's
Okay,
great
that's why I watch
TV.
this. Yeah, it's great too. It's great television to watch and see her like, oh, you're kidding me. So along the way, the judge asks her, what is her income? And she says, I make $400,000 a year. Okay. And she said it with such pride and such arrogance and such like, my ex-husband is such a loser, blah, blah, blah. And the judge immediately goes, okay, so you make this much per month, $34,000 a month, blah, 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 blah. And 40% of that is so much, and that's what you should be paying in child support. And she starts to go, well, wait, but I have expenses. And the judge said, no, you just told me you make $400,000 a year. When people say make, they mean that's what they earn, not what they gross in a
Right.
business. If my income were what I gross in this business, which has 90% expense rates on our revenue, I wouldn't be working, quite frankly. Never, I wouldn't have been working for the last 25 years. So the point is that this woman equated making money with her gross revenue.
Right.
And looked at her gross revenue as a way of saying, I'm special, I'm great, because I'm grossing a lot of money in this business. What was to her a lot of money. And it is a lot of money to most people. But she had no concept that the question was really about your profit, the number that matters, not gross revenue, quite frankly. It's nice to have a high gross revenue, but
But
it
that
doesn't
means
get
nothing
you
for your
it
life.
right. It doesn't help you pay your bills,
Correct.
your home bills, your personal bills, as opposed to just covering the expenses of the business. So anyway, gross revenue minus your business expenses is your profit, and your profit is either A, your income, or B, if you're paying yourself a salary, you can deduct your salary from your profit, and that's your salary. And then you also still have a bit of profit. And depending upon what kind of entity you are, that will determine whether that also is taxable to you currently or taxable to the entity. But that's a totally separate, thing. But for most people, profit is what they are, quote unquote, earning, because it's money that they theoretically have to spend. Okay. So anyway, that was an illustrative YouTube video for me, just about how people don't really grasp these terms, unfortunately. If they have no background in accounting or business, this is the kind of stuff that happens, unfortunately.
Just being in the online world, this would be a marketing ploy, a tactic for marketing to say, I'll help you. I was able to make this amount of money. Let me help you do the same. but that was always about gross revenue, not about their actual profit.
Yeah.
So it's a little bit of lack of transparency, I think. And then you go into what you just,
Misleading.
yes, misleading.
Misleading.
And then you go into what you just illustrated, which is the lack of education around financial concepts and financial terminology, which brings us to our discussion for today is
Okay.
what do you do when you are actually, I use the term making bank, but we can say bringing in a decent amount of money for your
Yep.
business, you're
Yep.
self-employed. First and foremost, I think what we need to do, and I'd love you to kind of illustrate what you think, what is making bank as someone who's self-employed? What does that even mean?
Okay. Okay. All right. We'll define it with numbers, right? We'll put numbers to it. But let me go to one quick concept first. I mentioned earlier gross revenue, expenses, net profit, and possibly salary as a part of that net profit versus some profit and leaving some profit behind. One of the reasons I said it that way was that everybody really should have a business plan. Where are we going? And part of knowing where you're going is what is it going to cost you to do it?
Mhm.
Profits of a business are money that can be reinvested for growth to push you forward, right? So you may not want to take all of your profit as pay at all because you need to reinvest. You're going to do a marketing campaign at the beginning of the year. That $8,000 of additional profit, you want to leave that as profit because you're about to spend it anyway, whatever. Okay. So from a business planning standpoint, you may be leaving profit in, and that's becomes not even a part of the conversation then. Okay. So what we're talking about is, first of all, just the money that you're going to be taking out of the business to spend on your personal expenses, your living expenses. Okay. So once you have that number, I'm going to spend, $90,000, $100,000 a year on my living expenses. The question is, by how much does your profit and or the amount of money you can take out of the company exceed those living expenses? Okay. Now, we always tell people you need to be saving at least 10 or 15% per year of your quote unquote salary, of the money that you're earning after all the expenses and what you're taking home effectively. Okay. So taking home is another term of art, right? But most people understand the concept of take home pay. So if you're saving 10 or 15%, and that's the minimum, we can't call that bank. Okay. I wouldn't call that bank. I would call that the minimum.
Mhm.
And if you're not doing that, in a sense, you're falling behind. Okay. You're just not keeping up with where you need to be. So then how do we define bank? Well, I can tell you that someone who can save 20 to 25% of what they're earning is someone who is going to be ahead of the game. And by the way, this assumes that you're from an early age, not that you're starting at 55 saving 20%. Okay. That won't get you anywhere. It helps, but that's not bank. That's not going to put you in a great retirement place. But if you're in your 30s, 20s, and you're an entrepreneur and you're able to save 20, 25% of your net profit or the money you're basically saying, this is for me, for my living expenses and my long-term needs. That would be far closer to something I would call bank, right? And anything over that, yeah, 30, 40, 50%. Somebody who's making $500,000 a year net profit, right? And only spending $200,000 a year. That person's making bank because after taxes, they still have 150, 200. They could probably save almost $200,000 a year in that scenario. So
Right.
I would say that person is making bank,
This
right?
is good. And for easy math, we can say an example would be maybe your living expenses cost you about $90,000 to $100,000 a year. You're taking
Yep.
home around 125. So you
Yep.
have like $25,000, $30,000 to do something with.
Yep.
Obviously, you'll have taxes that you need to pay, but that's probably you're keeping that likely separate in some sort of like tax account, I would assume,
Yep.
maybe.
Hopefully,
Right, right. So what would someone start to think about? Okay, say I have this extra at least $25,000 on my hands a year. What am I starting to think about? Where should I be putting that money? Should I be buying assets? Should I be investing more toward my retirement? Like, where should I start thinking about allocating those funds?
Yeah, well, similar to our hierarchy of needs, are my living expenses met? Yes. Have I saved all the money I need towards buying a home and I'm comfortable with where I'm at with that? Yes. Do I have some money put aside for an emergency? Yes. Um, do I have kids yet? Yes. No. If yes, am I putting some money towards that also? And if all of that is taken care of, and you have them, you're motivated to save money. Listen, bear in mind, there are plenty of people that I have met who, if they have $25,000 of excess income, vacations, Gucci, they'll spend it.
Yeah.
They don't think of saving. They think of today. They think of making themselves feel better today for whatever, for their various reasons, and they'll spend it. And as a financial planner, that kind of stuff drives me crazy, because they have the opportunity to put themselves in a better financial place long term, and they're choosing today over tomorrow.
Mm.
Right. And so talk about benefits of a financial advisor. One of them is that they bring people down to earth and keep them focused on today, but also the long term.
Yeah, because I feel like it's
Because
a bit of a balance. Like it is nice.
it's
I
absolutely a
love a
balancing act.
vacation. I like going out to eat, but at the same time, and this is where probably like the business plan, so that you can just keep your priorities in check and maybe have some of these things that you're doing monthly anyway. So it doesn't seem like, so if you're sending money to a Roth IRA account or sending money to save for your kids' college, like that's just part of what you do. And then you have excess to spend on, maybe the fun life things that you want to do.
Yeah. I mean, if you're doing 20% a year and you're doing a good job of that, but you still have another $10,000 a year that you could spend or save, no financial planner is going to say to you, no, 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 you must save that money. Because now it's a values decision.
Right.
You are achieving your goals. You're going to hit your goals, right? The goals you've stated, you're working towards them, you're meeting the need to get there. So the rest of it, that's up to you. If you want to, I as a financial advisor, it's not for me to say, no, 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 you shouldn't spend money for a kid to go to a special school, or special lessons in the violin, or whatever. You shouldn't do that. You should put more money towards retirement and get there even sooner than you want. I can't tell you what your goals are. I am not going to put my values onto you. That's unethical, quite frankly.
Right.
That's not what a financial advisor should be doing. If you say, I got an extra $10,000 and I'm only saving 5% a year, what I'm going to do is point out to you that you really want to be saving at least 10%, if not 15%. So it would be in line with your goals for you to put a portion or all of that money towards your retirement, so that you'll stay, on track to the achievement of your goals, instead of just spending it. Now, what you do after that, of course, is up to you. Because I'm not here to be a parent. I'm just here to be advisor to people.
Mhm.
So, okay. But, let's get back to the bank, to the people that have
Yeah,
bank.
what do I do with my money? I want to know. I'm
Yeah, yeah,
making a
yeah.
lot of it. What do I do with it?
Yep, yep. Okay, so we talked about the hierarchy of needs and things like that. Then there becomes a hierarchy of saving options, which we also covered in the other podcast. So just quickly, do I want the money to be in a tax deferred account, like a qualified retirement plan, Roth IRA type of an account, or do I want it to be in just a brokerage account where I'll pay taxes on the interest and dividends, but I'll have access to the money before I'm 59 and a half without paying penalties and all that kind of thing. So you have to decide that. Usually a financial advisor can help you, talk you through that part of the decision. If you're going to put money over onto the retirement plan side, then you have to choose a retirement plan type. There are multiple types of retirement plan, so at least 5 probably to consider on that side. Roth IRA, traditional IRA, simple plan, SEP IRA, profit sharing plan. There's something called a money purchase, and a defined benefit, but they really don't come into play for young people. By the way, there is an importance to this, that if you don't have a retirement plan, my father, your grandfather, your, great grandfather, companies used to have pension plans, and they used to have these retirement plans where they contributed for people. And it just really hardly exists anymore, other than some kind of a match. So this is a very, very important topic for most people. Okay. So you've got these options as to the type of account you put money into. Then eventually you have to make choices about what types of investments you're going to make within those accounts. Okay.
Mhm.
So, there are some limitations on retirement plans. For example, it's kind of hard to buy personal real estate in a retirement plan. So there are some challenges to that. Some
So
higher
you'd probably
costs.
just outright purchase, like you would
Yeah. You would
not do
use
that.
this side, which is the money that's not in a qualified retirement plan. If you want to buy a rental property, let's say, the second home, which isn't really a retirement thing, but a second home could be the same thing. So if you're using this type of account, that kind of real estate may be an option. But you're generally, for most people, they're going to be looking at a brokerage, what's called a brokerage account, or a company like a Merrill Lynch or a Schwab that gives you access to securities, to investments. And then the investment types are going to be stocks, bonds, money markets, certificates of deposit, mutual funds, and exchange traded funds. That's 99.9% of what people will use as the actual underlying instruments or securities. Okay. Now you get into investment strategy. And there are a series of things that you have to consider with investment strategy. Okay. Income taxes is a part of it, but you have to consider your age and your time horizon. How long will this money be invested? If you're 59, it may be a very different strategy than if you're 31. You have to consider your personal, what we call risk tolerance. How comfortable am I with ups and downs of investments, fluctuations in value of investments, possibly wildly fluctuating values, of investments, or risk of, for example, complete loss of an investment. I invested the money in ABC company. I thought it was going to tear up the turf. It turns out there was fraud going on, and we lost my entire investment. Okay. I mean, that can happen if you invest in an individual stock. The company goes bankrupt. The stockholders lose all their money in an individual stock if the company goes bankrupt. So you have to talk about risk tolerance and what are your comfort levels? How aggressive are you? How conservative are you? You have to look at those kinds of issues for yourself. You need to look at things like, is there a chance I would need this money? And how would I get at it if I do? So, for example, if you buy real estate, that's a completely illiquid asset. It's not, it takes months to turn real estate into spendable money.
Right.
Okay. Now, you might be able to get some kind of a credit line against some of your equity in it. You might be able to, you might not. That might be faster, but typically that's going to be 30 to 60 days. If you're looking for money in 3 days, a brokerage account with mutual funds and exchange traded funds, stocks, bonds, money markets, that money can be in your hands in 3 days. So you have to look at marketability, the liquidity of the money. How quickly can I get at the money? And can I afford to be in investments that go down? And am I still financially stable enough to weather an upturn again, eventually in those values? So, go ahead. Those are the critical elements of determining how to start investing.
Talked a lot about like priorities of what you want to kind of do first. If I am someone who has a little bit more liquid cash, over $25,000, maybe $100,000 on a yearly basis, that's just extra. would I be thinking about implementing a couple of these strategies? Like for me, I'm also very interested in real estate. So I could see myself, yes, doubling down on some of my actual like investment strategies in those accounts that we had talked about in this episode and the previous. And then also at the same time, would I be, maybe purchasing an investment property where that can cash flow and I can make $1,000 a month off that property. So I have some like liquid cash as well. And I think my question is, can these strategies be implemented at one time, or is it something you really want to like make a year focus where you're like, this year I'm going to do X, Y, and Z?
I think that's more of a personal decision, as long as the long-term strategy it makes sense. So, for example, it's going to be growth investing. You're young, it's retirement money. You think it can be there for a long time. So you're going to invest for growth.
Mm-hmm.
So real estate, you're going to try to invest in something that will grow in value. The property will appreciate in value, for example. Stocks, you're going to invest in stocks and you're investing them because you expect them to appreciate in value. That both of those would be considered growth investments. So I'll give you an example. You have $100,000 this year, as you said. Let's say you decide you want to buy a $200,000 rental property. You're going to put $40,000 down out of your $100,000, and you're going to borrow the balance from a bank, get a mortgage against the property, because you think you'll have more than enough rental income. And let's say there's a history with even the property you're going to buy, more than enough rental history to pay the mortgage, the property taxes, the insurance, and maybe even still send you a monthly check, a net rental income to you. So that property will grow in value, and as you pay down the mortgage, the equity will grow. So you got two sides of growth to that. And that's a very good growth investment. It's a lot of work, but it's a very good growth investment. So you could put 40 of your $100,000 there. You could take the other 60. You could put 7,500 into a Roth IRA, and you could put the balance into a brokerage account. And both the Roth IRA and the brokerage account, you buy S&P 500 index funds or emerging markets index funds, or something along those lines that give you stock market access. And now you have a fully growth-oriented portfolio for an early 30s person towards your retirement. Yes, nothing wrong at all with doing it that way, So, for the person who likes the idea of owning rental income producing real estate, that kind of thing, it's just time. A lot of people find they just don't have the time for it, especially once they have children or other things. Time becomes precious. And that's where kind of like simple stock market investing, kind of makes it a lot easier. And that's why a lot of people don't do rental real estate or, real estate, actual property investing. You can also invest in real estate holdings through a brokerage firm.
Right.
Limited partnerships, for example, stuff like
there's like syndications. You could
exactly.
I could just put money into something and then someone else could be doing the work. That's another
you put $20,000 into a growth real estate thing where they're going to do the leveraging, the buying, your money's going to go towards the down payment. Bear in mind, and I'll just say it, so I said it, the downside of rental real estate, where you put down 20% and, borrow 80, is that if the market for that drops 20%, you lose 100% of your money if you have to sell.
Right.
Because of the loan that you took against the property. So, a 20% drop in a $200,000 property is $40,000. Well, that's the amount of money you put in. Hopefully it doesn't go down more than that, because if you have to get out of it, now you have to put money in to pay the bank to get out of your own property.
So in some ways, would you say investing in the stock market is is it safer in your opinion, like compared to real estate? Because, that makes sense what you just shared. If that property goes down and you need out, you could be in a little bit of a pickle.
Yep. So safer isn't necessarily the word that I would use. The way I would look at it is this. If you think the stock market's going to get you 8 to 10% per year, there's the way you're investing, there's no chance you're going to have to throw in more money for your investments to keep it stable or to get out of it or what have you. And if you think the real estate's only going to make 8 or 10% per year, but you have the risk that to get out of it, you might have to someday throw in more money, then you have the same return, right? But a higher risk on one factor with the real estate. And that, for me, wouldn't be worth doing. Okay. So you have to look at now, if the rental real estate, if you think you're going to make 12 to 14% a year versus 8 or 10, that may be worth that added risk. But what you never want to do in investing is take something where you've got the same potential return, but one is riskier than the other. Don't invest in that one. That's nonsensical. Because everything you do in investing, you have to be looking at the risk versus the return and make sure that all of it makes sense going forward.
No, I feel like I completely understand it. And for the sake of not taking too much time talking about real estate as well, I want to just kind of zoom us out for a moment and talk about what we have shared in this episode, which
Yep.
is, obviously we're first going to be looking at our financial goals, figuring out, are we actually at a place to start investing our money, or are we still just at that like break even point and this is
Yep.
not the time for all those like extra things. So we might want to be looking into different investment strategies, opening up different brokerage accounts, investing into those on a yearly or monthly, yearly basis. We might also think about real estate. Maybe you think about putting money back into your business. Maybe you're going to hire an employee. Like maybe there are
Yep.
other like campaigns that you want to run within the business.
But you have to have a business plan in your mind at minimum, if not on paper. For the sake of argument, if you had a profit of $100,000 and you're going to add a $30,000 part-timer January 1, and nothing else is changing immediately. Well, what is you're going to be losing $2,500 a month of that $100,000 profit immediately.
Mm-hmm.
So you're going to need enough cash reserve left in the business over and above your general monthly amount, to make sure you can meet that need for however many months you're going to be in the negative, or you would think you're going to be in the negative before the value of that starts to improve your gross revenues. I mean, hopefully there's some relationship there, right? So, yeah, you have to do business planning before you decide what you can even take out of the business and save for yourself. And that stuff, this is part of why being a business owner, an entrepreneur, is so challenging, because maximum growth typically means maximum cash is needed. And so it's very, very hard to figure out what can I afford to take out, or be in a position where you think you can take out more money. And so you have to grow that revenue, grow that profit to the point where the company has enough cash, it can sustain the next phase of growth from its cash so that you can take out, what you're looking to save. It's just far more complicated for the business owner than it is for the person who works for XYZ company as an employee.
Oh yeah. They don't care what the company does with the money as long as they're
That's
still there
a
at the end of
company
the day.
issue.
Yeah.
How to, what happens with profit is a company problem, not your personal employee problem.
And this brings us back to one of our earlier episodes. What are some of the personality traits of being self-employed and being an entrepreneur? Because if you're not a person who wants to think about those things, there's incredible advantages of working for a company as well. You don't need to think about that. You are going to likely have a company match where they're going to be putting money in to your retirement account as well. And you just don't need to think about some of these things. So yeah, the entrepreneurship life, much, much riskier, but you do get to make some of these potentially fun decisions of what do I do with my money. So I hope that this episode kind of gave people, even if they're not there yet, starting to think about what could I do if I was, had a little bit extra profit on a yearly basis. Where would I want to allocate that money?
Yep. And we should have a separate thing that is just about investment strategy, because there's just so much to that too. We just covered the basics of it today. But that's that. We've covered a lot of process questions today. How do you get to that point of deciding you can save the money? What are the possibilities as to how to save the money? When you get down to the brass tacks of what are the actual investments for me, You need to understand your options. You need to understand why certain ones are better than others.
Absolutely. Yeah. It is. It's this dance we're trying to find with the show of not going too deep into some of these concepts so we go completely over people's head, but also
Yeah.
still like providing really good information. So let us know your thoughts. If you have any questions while you're listening to these episodes, please don't hesitate to reach out to us. You can find us on The Financial Dad, usually all over social media, thefinancialdadpodcast.com, and let us know what you think about the show. We're so grateful to have you here. And thanks today, Dad, for another great episode.
Thank you, Bridget. See you soon.